having learnt all about Brexit, we're now setting our sights slightly wider and talking about disruption. And we have a very good panel. Chris Derbyshire from Seven Investment Management. Chris, I think you're sat here. Moritz Sitter from Baillie Gifford. Hi. In the number 2 slot, Moritz, yes. Yes, Casper Rock from Schroders. And a surprise late addition, Graham O'Neill from RSMR. Is down the end. Graham, you down the end? Graham. Graham, if you sit down the end, Graham, and just you move up one, please, please, Casper. Disruption is a strange term. It's one that it's kind of a euphemism for someone doing something better and eating someone else's lunch. And we all know examples of disruption: Amazon eating retailers, putting booksellers out of business, and all that sort of stuff. I'd like to just start by asking each of the panellists, starting at this end and running down. We know about the sectors that have been disrupted. That's easy to describe. What about the next ones? And then also quickly, which ones won't be disrupted? Which ones have the natural defences that mean they're going to be okay? Chris, could I start with you?
Disrupted by what is the obvious. But I think what sectors are out there most likely to be disrupted that hasn't really been picked up by the market? I think the tech sector. The Russian involvement in elections. I heard yesterday that Facebook only realised that there was Russians buying adverts because they actually bothered to check the currency they were buying in. That was a year after the presidential election.
You're talking about a very different kind of disruption here, aren't you? You're talking about something that might actually hurt the disruptors.
Well, indeed, yeah, I guess that's right. So they were the disruptors. Now they are the status quo. Really, they've created these markets that are very different from the former markets, but are now quite solid and beginning to be monetized. So I think the tech sectors are kind of an easy win there. No risk priced in, no political risk priced in, but all you read about is political, risk. And country by country, as you go around the world, they're beginning to take aim at the tech companies and social media generally.
What about sectors that going back to the original meaning of disruption, will be okay, that won't face competition from an Amazon, or should be, even General Electric is planning for Silicon Valley now. So who won't be hurt? Or who do you think won't be hurt?
Sectors that won't be hit.
There are none.
Well, I'm struggling.
Have a think about it, Chris. Morris, if I can move on to you, what about, what do you think about in terms of the next ones? What's the next cab off the rank, if I'm not using an Uber?
Yeah, I think you could name a couple, but the one I would probably pick out would be the financial industry, banking and asset management. I mean, talking about our industry ourselves, we have the formidable force that is Vanguard, the Vanguard Group, that has done a terrific job disrupting certainly the asset management industry in the US, and they're making their first forays into the UK as well now. So, and then banking, I guess, would be, I think there's plenty of players that haven't really invested in technology, nor are they very customer-centric. So I don't think there's a lot of satisfied banking customers out there.
Do you see, Facebook does have a banking license after all, and if you go to China, banking transfers are done by messaging systems. Do you think Silicon Valley will get serious about banking, and Apple might be the next JP Morgan, for example?
I don't know. I don't even know whether it will come from the Silicon Valley. I mean, one holding that we have in our fund, Avanza Bank, is an online savings platform in Sweden that is disrupting the savings market there and doing a pretty good job in our opinion. So I think it doesn't necessarily have to come from the Silicon Valley. It can be, because yes, Silicon Valley has the advantage of having a deep pool of venture capital which is needed to grow businesses, but actually the requirements for capital in order for a business to grow has probably fallen quite a lot.
It also has a relationship with customers.
Yes, yeah.
Which is the key thing.
Yeah, that's true.
What about those you think might be immune to disruption? Probably a harder question.
Yes, a much harder question. I would say, I think it's a good question to ask this this question of will this business or can this business be disrupted to any industry. So I think any industry can be disrupted. I'm not sure whether it won't be, but any industry where you have a discrepancy between what the customer wants and what he's being offered, that's a potential for someone to come in.
There are some physical boundaries, aren't there? If you're in an airport, you're never going to get disrupted by a Facebook.
Yes, but then you might get Elon Musk coming up with the new super jets and that fly much quicker, and then you perhaps need less of an infrastructure around airports, so you just fly directly to Rodding Park instead of flying to Leeds Bradford. But I don't know.
Yeah, we did take the Hyperloop to the conference.
Yes, exactly.
Maurice, the same question to you. We've talked about financial services. Another sector, perhaps, that you could think of?
Well, to me, there are a couple of things you've got to think about. Disruption has always happened, always will, and will carry on happening, but it's happening a little bit faster at the moment. And if you take the example of the music industry, so 30 years ago, musicians would use their album, their tour, their music tour, to promote their album. Now, they use their free album or their streamed album to promote their music tour. And what they do is they spend their time really investing not only in their own music, but their own image. And building that strength of brand protects you against these behemoths. So if you look at the spat that Taylor Swift got into on iTunes or Apple Music, she basically went on strike and put off the launch of this whole platform because she had such a strong brand image. And I think having personal and corporate brand image is becoming more and more important, and you can't stop investing in it.
And you might say she's won that because her new album, which came out the weekend, has sold 2 million copies in 3 days. Physical copies.
And,
bizarre.
well, come on, 70% of LPs, the old vinyl discs, are bought by people who don't have record players.
Sorry, say that again.
Work that one out. 70% of LPs that are bought by people at the moment are bought by people who don't have record players.
Right.
Yeah, really interesting. No, but I'll come back to the point. The point is brand, personal integrity is the first thing.
Which can't be disrupted.
Which is very difficult to disrupt, but you have to keep on investing it. That's really, really important. And the other thing is personal service. So if you take, for example, Build.com, which is Ferguson Woolsey's US business, it has 21% share of the online building materials market in the US. Why? Because they have people on the end of the phone who can really talk to people buying this stuff. Amazon only has 14% market share because they don't have people on the end of the phone who can say, I want that little widget that specifically does this. Build charges higher prices, but it's growing faster and has more market share because of the service that they provide.
Graham, the same question to you. Another sector that might.
First of all, I think it's
liable.
worth thinking about what disruption is, and it means things aren't occurring in a way that were considered normal in the past, and that's why it's so hard to forecast what will be hit next. And people quickly woke up in retail. Amazon was the prime example there, if you'll pardon the pun. Then investors then woke up to the fact this wasn't so good for retail property REITs in the States with record numbers of bankruptcies. So if you're investing in that sector with the high ratings now in technology, you want to have stocks that have either network effects, or I'd actually say the Chinese internet names have a lot of protection. There's been a policy in China for a number of years under Xi, not just from this Congress, to promote national champions. So I don't think China would let either Tencent or Alibaba be disrupted. You've got the great firewall of internet censorship. So I think they've got protected franchises in the technology space. Outside of that, global consumer staple brands I think would be very hard to disrupt. How they get to people can be disrupted.
Can I disagree there?
Yeah.
Well, finish
Please
what
do.
you're saying, then I'll disagree.
So you think that Colgate or Gillette, for example,
Yeah, and the other
fine.
sector, in terms of looking at funds, global listed infrastructure, I think is a sector of funds and there are a number of global listed infrastructure funds available that will be very hard to disrupt. So
Because they own those physical assets and not
They've
making...
generally
and no
got
one's making any more
monopoly
of them.
assets,
Yeah,
and
yeah.
they've generally got inflation-linked pricing power.
Maurice, you were going to say?
Casper.
Casper, excuse me,
Don't
Casper.
worry, don't worry, don't worry.
Too many,
No,
I've got-
just on the Colgate Palmolives of this world, they're getting a lot of pressure from the private equity people to cut what is A&P, which is advertising and promotion. And that's gone down and down. And so profit's gone up and up. So basically, they've stopped investing in their brands. A few years later, guess what happens? The brands slow. So you look at Reckitt Benckiser, you look at Unilever, you look across the board, they have slowing top-line growth. That's not good for their rating. Then what do? They go and spend $1 billion on Dollar Shave Club. Or they go and spend $1 billion on George Clooney's lovely drinks. Because they have underinvested in their brands.
So you actually get into a vicious downward
Yes,
cycle.
you could get into a vicious downward cycle.
Yeah.
Do you think there's also another factor at play here, which is that the likes of Amazon just have more power, and with the internet you have more transparency, which makes it harder for brands to command a premium in pricing compared to private label, for instance? 20 years ago, private label was white label. Now it has its own brand, doesn't it?
I do think cutting marketing expenditure is dangerous. And I know that's the reason steward investors are selling out of Unilever, but they're not selling out of Henkel, which produces Persil. So you've got to be selective what you pick up. And I think that the cutbacks in marketing expenditure could really affect Unilever's future growth.
Yeah, and there's been great comments this year from Martin Sorrell on this very point about WPP is suffering
They're suffering badly because of it.
because of the exact process. How perhaps to you, Moritz, how do you spot, because everybody wants to be on the next big thing, the next big disruptor, how do you tell a Napster, the music service that was meant to disrupt all the music services but didn't go anywhere in the end, from a Spotify or a Amazon or a Facebook? Because it's easy to invest in a new thing, but how do you know which new thing is going to be the right new thing?
I think, it involves judgment, and I think it involves, in some cases, looking at the history of similar industries, trying to figure out what are the factors that really mattered. And I guess one of the lessons perhaps with Napster and MySpace at the time would be that perhaps it's not always best to be the first one. The first one is often the one that comes against a set of laws. If you remember Napster, they were sued and they were bankrupted by the music industry. So I think it often takes the second or third one to come in. Peter Thiel talks about Facebook having had the last mover advantage because they were the last network, but they did it right. Whereas Friends and MySpace were the first ones, but they just didn't manage to obtain critical mass, and perhaps it wasn't just the right moment when they came in. So that would be one thought. And then another thought would be, it comes down to assessing, with a business model that is very disruptive, that is new, where you have very, very little to look back on in terms of the track record of a business. I guess it becomes very much a judgment of management. So, and I would generally look for managers that have skin in the game. That means they're not heads I win, tails you lose. They suffer when you suffer, and they win when you win. So that would be one thing to look for.
So you're not a fan of Snap?
Not personally, no.
Casper, could I ask you the same thing? So let's take another example. Uber. Is Uber going to be remembered as a Napster or an Amazon?
I think there are threats generally to cars that weren't even covered earlier on, which is, do you need to own a car? Which is even more of a sort of existential threat even to Uber. I think I wouldn't buy Uber at the current price. I wouldn't buy Tesla at the current price, because I do think that more and more is the gig economy and the ability to use something when you want it, then give it back, rather than having physical ownership. You don't need. There's less of a need to own things these days, and so why would you buy a car when you can just borrow one?
So that's a pro-Uber argument then.
Yeah. But So I spent, before I joined Cazenove a year ago, I had 6 months gardening, which was lovely, but I spent 2.5 months at Stanford Business School looking at a couple of things around disruption and change. And we would look at all these platform companies, and you think about it, Airbnb is the biggest provider of accommodation, owns no accommodation. Uber, biggest provider of cars, owns no cars.
Employs no drivers.
Well, yes. But then you think about Facebook, and really doesn't provide its own content. They are just platforms. And if you think about where they make their money, if you think about the big companies, you think Amazon makes its money out of web services. It's not about selling stuff. That's where it really makes its money. iTunes makes it, Apple makes it out of iTunes. It's not the devices that really help it. It's the connectivity and the network they have. And that's the real strength of these businesses.
So over time, though, will the value accrue to the platforms and the distributors or the people who own the assets?
I think it's the platforms. So the Google algorithm is where all the money is made. They lose money all over the place doing weird and wacky stuff elsewhere, and it's all called Alphabet now. But it's the gross margin on the platform. That's the real strength of the business. That's the real strength of business. And every time you use it, they learn more about you, and they can give more targeted stuff, and they can charge the advertisers more. It's brilliant.
And Graham, if I could ask you, how do you tell a Napster from an Amazon? Are there any key early warning signs?
I don't think I'd try.
So you take an actuarial view, invest in them all, and one will be okay?
No, I wouldn't necessarily do that. There is another way to try and invest and exploit disruption, and that's maybe... I remember, in the mining boom of a few years ago, people tried to look and invest in the picks and shovels rather than the people digging the holes. And there are a number of companies that are actually supplying manufacturing parts for disruptive industries, artificial intelligence. A number have actually located in Japan, and last year the winner of our One to Watch manager, Sophia Lee, runs First State Asia Japan Focus Fund. Very successfully exploited this theme with automation stocks and other companies supplying some of the chip makers with technology that can't be replicated elsewhere. And maybe that's one way to think about it, because you don't need to actually pick the winner as long as the theme is a winner. And that's been one of the best performing Japan funds year to date.
Chris, could I come back to you on a point you raised first off, which is there is this, the other source of disruption, which could be regulation. Some people have talked about what happened to Standard Oil before the war, the Rockefeller dynasty being dismantled by the US government because of monopolistic concerns. Are we getting that way with companies like Google, Facebook and Amazon? And actually, have they, is this the high tide, and is it only going backwards from here?
I would say yes. I think we're at that point where they've become so powerful, they're not just beginning to alter our culture and our society, but they're beginning to change the path of elections, to change the nature of politics. Look at the way Trump communicates with the masses via tweets, which really are very kind of full of lies, frankly. This is, a kind of absence of morality has been unleashed upon the population. The population living in their echo chambers are not geared up to be able to protect themselves against it. So I do think you need, rather like, the media industry and the advertising industry has kind of bodies around them to protect them from outright lying. There's no such body around social media at the moment. So I think, regulation is inevitable, and we are probably at the high tide simply because they're beginning to make real money now.
So you think Facebook and Google in future might be treated as normal media companies and be subjected to normal media regulation?
Well, they sort of become the new utilities, if you like, and we all depend on them for, how much time of your day do you spend consuming something, either Google, genuinely working, or just Twitter on your phone. And maybe the two overlap quite a lot. I use Twitter for work a lot. So it's 3 or 4 hours of my day, probably. It's there.
Now, what about tax? Tax is an issue as well, because the European Union in particular is using tax as the thin end of a wedge to try and get a hold on these very big companies, very big global companies.
It's one angle of attack. Kind of reminds me of, they went after the tobacco companies on health, they went after the banks on just general behaviour.
Al Capone on tax, I think.
Yeah, so I think you can tax is one area. The EU's also gone after Amazon, I think, on competitive grounds. But that's just the beginning. That's the tip of the iceberg. The real issue is you are not running your business in a responsible way.
Are governments big enough to take on Google?
Absolutely, I would think they are. I think it's difficult to see how the legislation comes to a point where it impacts in the way that a China can suddenly impact and turn off a Google algorithm. A government can simply clamp down on one company in that nation. Well, you've lost a little bit of your network as a social media company. You've lost a little bit of that globalizedness. So I still think it can happen.
I think it's also worth remembering that these companies, like any company, they have a life cycle. Right now, Google, Facebook, Amazon, they're all still run by their founders, but at some point you would expect them to hand over the reins, perhaps not in the next 5 years, but next 20, 30 years, and then these might be the big behemoths that are then getting disrupted again. So I think yes, there is regulation, and I think that is a big risk for these companies, but I also think that there's a natural tendency of big organizations to become bureaucratic, to become slow-moving, to become less innovative over time, especially once the founders have passed on the reins. So, and then they open the door for new, smaller companies to come in and challenge them.
Casper, can I ask you to start us off on another big subject around this, which is artificial intelligence, which it seems to me every few years we have another sort of mild seizure about the idea of robots doing our jobs. How do you sort of sum it up and think about investment to benefit from artificial intelligence? How can you make money from it?
Part of my time at Stanford, I went and looked at all the Roboadvisors because I thought they're all based there. Let's go and talk to them. And I went to see the biggest one. It's called Financial Engines. It runs $110 billion. And
I'm sorry, so 110 million?
110 billion.
Billion, excuse me.
A lot of 401ks. But actually, if you're anybody from Hargreaves Lansdown or Standard Life, turn your heads away now because the margins they make would make you weep on their platform. They are so low.
How many people do they employ?
Not very many. But what they have had to do in the last year or so, they've had to, in the Stanford language, pivot. It's a very fashionable word, pivot. And so they had to change their strategy, and they bought people to talk to on the end of the phone because financial transactions are around trust, again, and there is complexity. So all the robo-advisors had really been competing on my algorithm is better than your algorithm, and I've got more Nobel Economics Prize winners on my board than you have on your board. And that was the differentiator. And then they've realized actually you need someone on the phone, someone to talk to, someone to interact with. And so that's
How long will that persist, though? Because will the next generation actually be quite happy not to have someone on the phone?
Well, maybe, but you see, Eric Schmidt said literally yesterday, Google's algorithm can't tell the difference between fact and fiction. So if you're taking investment advice from someone that can't tell the difference between fact and fiction, it's not a great place to be, is it? So what I would say is you've got to think about disruption, not just about being technology. It's about being more efficient. And if you just flip on to think about banks, if you use blockchain rather than all the old-fashioned stuff that you use, it collapses the cost. Approximately, some people think it may take about 2/3 of the cost out of a bank. That's the first thing, and that's really quite cool, although bank clerks might be losing jobs, I'm sorry. But the other bit is, instead of settling transactions T+1, they can do it every hour. So a bank will be able to turn over its balance sheet 24 times a day, and suddenly your profitability, your return on equity could go through the roof. So there could be great benefits, but I don't think we're going to be out of jobs just because artificial intelligence will do everything.
Graham, any thoughts on AI?
Well, I don't invest in stocks, but when I'm looking at funds and fund managers, I want to make sure that a fund manager does have an understanding both of the opportunities and the risks from areas of disruption, such as AI. And we've seen that actually in certain fund strategies over the last couple of years, such as mean reversion strategies, have really struggled where managers have wanted to ignore that the world is changing. A point I always remember is that after the introduction of the motor car, the profits of horse owners did not mean revert. So I'd want to see a fund manager that understood the culture of disruptive companies, and had shown a successful record in investing in them and understanding the risks investing there, and maybe took a basket approach to the riskier ones.
But do these people exist? Because, as we well know, picking winners in this field is really, really hard.
In terms of funds,
Well, no, in terms of the fund managers picking the right companies for you to
well,
then
there
invest in
are
the funds.
certain fund groups that have done very well. Someone to my left who works for Bailey Gifford has seen great success in investing and exploiting disruptive technologies. So it's down to having people that are good at fund selection working for you. So I'm lucky I'm with RSMR, and you're lucky you're all clients.
And Moritz, AI.
Well, I think it's another technology, and I'm sure there's some fields that fields that are quite ripe for disruption in that sense. Anything around automation and so on, taking over at least simpler tasks. But it's also a technology that can be adapted by incumbents. I'm not as dystopian as some people are on this subject, actually. I think it can be, in many ways, it can be a help to decision makers or to businesses and how they run their processes and how they manage their business.
How close is it to being, we say it as an AI, of course, it's a whole range of things that a lot of which are already in use now. But is there going to be a tipping point where suddenly we see an awful lot of AI running around and doing stuff that was done by people before?
You probably already see lots happening, you just don't see it as much. It happens in the background.
Yeah.
If you look at what Amazon is doing and so on. So I think there's already lots happening. We just don't necessarily notice it because it isn't affecting, for instance, the bricks and mortar retail businesses or the businesses that we can touch, let's put it that way. But I think there's already lots happening. Yeah.
And Chris, artificial intelligence, what on your horizon?
I would highlight that it has a very direct impact on capital markets. 2/3 of trading in equities around the world is now done by algorithm, not by human being. So here we are up on the stage, a bunch of human beings trying to talk about asset values in human terms, and that a good company will go up because it's going to make profits and be immune from regulatory risk or whatever. But the machines don't really care about that. They're just seeking patterns. And we've seen it in markets around the world where you become very dominated by algorithms. The patterns begin to change and they become sort of more machine-readable patterns and less human-readable patterns. And actually...
Sorry, explain what you mean by that.
A good example of this is the Hong Kong betting markets. People in Hong Kong bet on everything. They bet on 4th Division Australian football teams, etc., etc. And those markets have become increasingly dominated by algorithmic trading strategies. And what that strategy does is it comes in, it looks at the patterns in markets, which start off being human-originated patterns. It devises a pattern to exploit that. That exploitative pattern becomes part of the market. That new pattern merges with the human pattern, but changes the overall pattern. So the new pattern is a hybrid human-machine pattern. And then the next algorithm comes along, exploits that hybrid pattern. It becomes now a little bit more machine-driven and a little bit less human-driven. We're probably not far away from financial markets being in the same situation, but it's just waves and waves of algorithms.
Does that mean that everyone talks about markets being driven by greed and by fear? Well, of course, machines don't feel any of that. So will markets start to ignore signals that previously would have caused human traders to buy or sell?
Yes, I think so, and I think the signals will change over time that stimulate markets. We've already seen, I think, a bit over the last few years with more correlation trading going on, which was, not so... trading was sort of linear in an asset class before. Now it's correlated across different asset classes. Often it starts for good reason, but then quite often the correlation kind of becomes extreme, and then at extremes of the market, and Q1 2016 was a really good example of this, you begin to get strange anomalies occurring that a human can then jump in and take advantage of, as long as you can ride out the sort of irrationality of the market.
Because I think a lot of individual investors would be quite horrified by that sort of that scenario you've painted just then of actually the markets kind of running on in their own course and being a little bit out of human control?
I think it is horrifying, frankly. You don't know if, take the market today, you don't know if the market today is actually being driven by momentum trading strategies, by short volatility strategies, by risk parity strategies that look for low risk asset classes and then just pile it. You don't know how much of the movement in markets, how much of the decline in volatility, how much of the valuations are due to that. And that will unwind, of course, when something happens to disturb the markets.
Casper, can I ask you about AI as it applies to markets? Have you had a look at this?
I think about it in a slightly more simplistic way. Look at the penetration of passive investment within, let's say, the US equity market, where 2012 was roughly 28%. It's now nearly 50% of the US equity market. You can find where there are sectors where there are big sector ETFs. You can find companies where 2/3 of the shareholder register do not care about valuation. So where is the tipping point? At some stage, there will be a tipping point for that. And I'll just throw in a different curveball, which is the ultimate disruptor, I think, could be higher interest rates, which is an odd one, because looking at the Bank for International Settlements did some research on zombie companies, which are those companies that have a higher interest bill than their earnings before interest and tax. And that has gone in Europe from 5% to 11 or 12% of the entire market capitalization. And it's 16% in the US.
So these are not quite zombies, but they are...
If interest rates go up, they are
zombies.
seriously going to become zombies. And that is as much disruption as technology could ever bring along.
Just a quick question for all of you to finish, really. Is there now, given all the things you've talked about, any such thing as a long-term investment? Because given that everything is liable for disruption, machines are in the market, what is a long-term holding and can you justify it, Chris?
Well, given that we're talking about technological disruption, I guess your long-term investment for me would be something like the NASDAQ 100. So if you can't beat them, join them sort of thing. And that's probably diversified enough that you don't have to be a stock picker, which, as you say, is very hard. You really even have to be a sector picker, which I think is actually equally hard, although there are some spectacular successes out there. But the argument is, for me, do you need a hedge in your portfolios against technological disruption? Yes, but maybe not at these valuations, but yes, I think is
Moritz?
I think you can still be an long-term investor. I think it just changes. I think your analysis, or our analysis, has changed in that we put a lot more emphasis now on management and trying to understand whether the organizations that we invest in are adaptable, whether they really are innovative and are willing to invest in innovation or in deepening their moats, their competitive advantages. And I think that's a shift that is very important because if you focus too much on tangible competitive advantages, then the risk is that you sort of always look backwards and you think, well, this is a great business, it had fantastic returns on capital over the last 10 years. Well, I think that was easy. That, in that sense, investing in the past was easier, but I think it's a shift in where you focus your analysis. But I don't think it's an end to long-term investing.
Casper?
I think there is that you get a risk premium for taking risk, and you should be diversified. To me, that's the most important bit, is don't put all your eggs in one basket. You have to be diversified in your portfolio construction to hedge yourself against being sideswiped. You have to.
And Graham?
I think we've always had disruption. I think it's greater than it was before, and I'd include in disruption of market valuations by central bank interest rate policy, and disruptive politics, perhaps fostered by QE, which could be called welfare for the wealthy. So I think that if you look back at investment history, taking a longer term view always pays, and in fact it's actually harder, I think, to make short-term forecasts in an era of disruption than maybe longer-term ones.
Thank you very much. We didn't even get onto quantum computing. Thanks very much to our panellists, Chris Derbyshire from Seven Investment Management, Moritz Sitter from Baillie Gifford, Casper Rock from Schroders, and Graham O'Neill from RSMR. We're due for another break now. See you back here in 15 minutes. Thank you.